The American subprime mortgage crisis was a multinational financial crisis that occurred between 2007 and 2010 that contributed to the 2007-2008 global financial crisis. The crisis led to a severe economic recession, with millions becoming unemployed and many businesses going bankrupt. The U.S. government intervened with a series of measures to stabilize the financial system, including the Troubled Asset Relief Program, TARP, and the American Recovery and Reinvestment Act, ARRA. The collapse of the United States housing bubble and high interest rates led to unprecedented numbers of borrowers missing mortgage repayments and becoming delinquent. This ultimately led to mass foreclosures and the devaluation of housing-related securities. The housing bubble preceding the crisis was financed with mortgage-backed securities, MBSs, and collateralized debt obligations, CDOs, which initially offered higher interest rates, that is, better returns, than government securities, along with attractive risk ratings from rating agencies. Despite being highly rated, most of these financial instruments were made up of high-risk subprime mortgages. While elements of the crisis first became more visible during 2007, several major financial institutions collapsed in late 2008, with significant disruption in the flow of credit to businesses and consumers and the onset of a severe global recession. Most notably, Lehman Brothers, a major mortgage lender, declared bankruptcy in September 2008. There were many causes of the crisis, with commentators assigning different levels of blame to financial institutions, regulators, credit agencies, government housing policies, and consumers, among others. Two proximate causes were the rise in subprime lending and the increase in housing speculation. Investors, even those with prime or low-risk credit ratings, were much more likely to default than non-investors when prices fell. These changes were part of a broader trend of lowered lending standards and higher-risk mortgage products, which contributed to U.S. households becoming increasingly indebted. The crisis had severe, long-lasting consequences for the U.S. and European economies. The U.S. entered a deep recession, with nearly 9 million jobs lost during 2008 and 2009, roughly 6% of the workforce. The number of jobs did not return to the December 2007 pre-crisis peak until May 2014. U.S. household net worth declined by nearly $13 trillion, or 20%, from its second quarter 2007 pre-crisis peak, recovering by the fourth quarter of 2012. U.S. housing prices fell nearly 30% on average, and the U.S. stock market fell approximately 50% by early 2009, with stocks regaining their December 2007 level during September 2012. One estimate of lost output and income from the crisis comes to at least 40% of 2007 gross domestic product. Europe also continued to struggle with its own economic crisis, with elevated unemployment and severe banking impairments estimated at €940 billion between 2008 and 2012. As of January 2018, U.S. bailout funds had been fully recovered by the government, when interest on loans is taken into consideration. A total of $626 billion was invested, loaned, or granted due to various bailout measures, while $390 billion had been returned to the Treasury. The Treasury had earned another $323 billion in interest on bailout loans, resulting in a $109 billion profit as of January 2021. The immediate cause of the crisis was the bursting of the United States housing bubble, which peaked in approximately 2006. An increase in loan incentives, such as easy initial terms and a long-term trend of rising housing prices, had encouraged borrowers to assume risky mortgages in the anticipation that they would be able to quickly refinance at easier terms. However, once interest rates began to rise and housing prices started to drop moderately in 2006 to 2007 in many parts of the U.S., borrowers were unable to refinance. Defaults and foreclosure activity increased dramatically as easy initial terms expired, home prices fell, and adjustable-rate mortgage interest rates reset higher. As housing prices fell, global investor demand for mortgage-related securities evaporated. This became apparent by July 2007, when investment bank Bear Stearns announced that two of its hedge funds had imploded. These funds had invested in securities that derived their value from mortgages. When the value of these securities dropped, lenders demanded that these hedge funds provide additional collateral. This created a cascade of selling in these securities, which lowered their value further. Economist Mark Zandi wrote that this 2007 event was arguably the proximate catalyst for the financial market disruption that followed. Several other factors set the stage for the rise and fall of housing prices and related securities widely held by financial firms. In the years leading up to the crisis, the U.S. received large amounts of foreign money from fast-growing economies in Asia and oil-producing and exporting countries. This inflow of funds combined with low U.S. interest rates from 2002 to 2004 contributed to easy credit conditions, which fueled both housing and credit bubbles. Loans of various types, mortgage, credit card, and auto, were easy to obtain and consumers assumed an unprecedented debt load. As part of the housing and credit booms, the number of financial agreements called mortgage-backed securities, MBS, and collateralized debt obligations, CDO, which derive their value from mortgage payments and housing prices, greatly increased. Such financial innovations enabled institutions and investors around the world to invest in the U.S. housing market. As housing prices declined, major global financial institutions that had borrowed and invested heavily in MBS reported significant losses. Defaults and losses on other loan types also increased significantly as the crisis expanded from the housing market to other parts of the economy. Total losses were estimated in the trillions of U.S. dollars globally. While the housing and credit bubbles were building, a series of factors caused the financial system to become increasingly fragile. Policymakers did not recognize the increasingly important role played by financial institutions such as investment banks and hedge funds, also known as the shadow banking system. These entities were not subject to the same regulations as depository banks and did not have capital requirements or access to reserve credit lines at central banks. The shadow banks were vulnerable because they borrowed short-term and liquid markets to purchase long-term, illiquid, and risky assets. This meant that disruptions in credit markets could make them subject to rapid deleveraging, selling their long-term assets at depressed prices. This happened during the crisis and greatly amplified the financial shock. Moreover, many of these institutions had become dependent on short-term, often overnight, funding markets subject to disruption. When these markets dried up, institutions were unable to obtain funds to operate. The government-sponsored enterprises Fannie Mae and Freddie Mac guaranteed and purchased vast quantities of such mortgages. Both were placed into conservatorship in September 2008, causing their stock prices to plummet. The Federal Reserve, the central bank of the United States, took several steps to address the crisis. It dramatically reduced the federal funds rate target from 5.25% in September 2007 to a range of 0 to 0.25% by December 2008. It also created a variety of lending programs to provide liquidity to the financial system. The U.S. Treasury provided bailout funds via the Troubled Asset Relief Program, TARP, which was signed into law by President George W. Bush in October 2008. The Financial Crisis Inquiry Commission, FCC, formed by the U.S. Congress in 2009, concluded in January 2011 that the crisis was avoidable and was caused by widespread failures in financial regulation, dramatic breakdowns in corporate governance including too many financial firms acting recklessly and taking on too much risk, an explosive mix of excessive borrowing and risk by households and Wall Street. Key policymakers ill-prepared for the crisis, and systemic breaches in accountability and ethics at all levels. The Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in July 2010 to promote the financial stability of the United States. It created a new Consumer Financial Protection Bureau, implemented changes to the Federal Reserve, the Securities and Exchange Commission, and the Federal Deposit Insurance Corporation, and included rules to limit the ability of banks to engage in speculative investing and trading. The impact of the financial crisis was felt globally. Banks around the world suffered major losses, and several had to be nationalized or received government bailouts. Countries with banking systems that were heavily exposed to U.S. mortgage-related assets, such as the United Kingdom, Iceland, and Ireland, experienced severe financial disruptions. In the Eurozone, the crisis exposed underlying weaknesses in the economies of countries such as Greece, Portugal, and Spain, leading to the European sovereign debt crisis. The crisis also led to a significant rethinking of financial regulation and supervision, both in the United States and around the world. International efforts to reform financial regulation were led by the G20 and the Financial Stability Board. In response to the crisis, central banks around the world took coordinated actions to provide liquidity to the financial system. These actions included lowering interest rates, providing emergency funding to banks, and purchasing government securities and other assets in a process known as quantitative easing. These measures helped to stabilize financial markets and support economic recovery, but also led to concerns about inflation and the long-term effects of low interest rates. The financial crisis had significant social and political consequences. It contributed to increased political polarization, the rise of populist movements, and growing distrust in financial institutions and government. In the United States, the crisis led to the Occupy Wall Street movement, which protested against economic inequality and the influence of money in politics. In Europe, the crisis fueled anti-austerity protests and the rise of political parties that challenged the established order. Despite the recovery of financial markets and the economy, the legacy of the crisis continues to be felt. Many individuals and families experienced lasting financial hardship, and trust in financial institutions remains low. Policymakers and economists continue to debate the causes of the crisis and the effectiveness of the responses. There is broad agreement, however, that the crisis exposed serious weaknesses in the global financial system and underscored the need for strong regulation and oversight.